Hello everyone. I want to thank you for making the time to spend today on this Q&A and training call. We'll be speaking about a lot of different things, but I will tell you that based upon the questions that I have received, over 2/3 of the bankers who responded had a question that in one way or another touched on EVE or non-maturity deposit assumptions. And of course they're closely related, and we'll speak more about that today. But I will tell you that I am Howard Lothrop. I am here today to share with you on this training webinar. If you do have questions, obviously we're going to be able to answer them. Many of you sent questions in advance. We will have the question box available as well. Quick disclaimer, data used here comes from sources public and private. We don't necessarily warrant its completeness or accuracy. We organize this process, but we are not providing accounting, regulatory, or legal services, and this is general informational purposes only, and you must determine if this is suitable for your specific needs. So if anybody has questions, please again make sure you submit them via the question box on the right side of the screen. So let's do a quick overview on EVE. The economic value of equity is a measure of long-term interest rate risk. It's based on the concept of discounting the present value of cash flows. With EVE, what you need to do is to create a simulation that's long enough so that all of the assets and liabilities that are being tested fully reprice. Ultimately, once you've done this, you then take the present value of the cash flows of the assets, subtract the present value of the cash flow of the liabilities, and that residual amount is EVE. Now, when you think about present values of cash flows, and we'll just do a quick simple review here of some basic relationships. You know, it all comes down to the fact that $1 today is worth more than $1 tomorrow, and that's really what the concept is here today. If you think about your investment portfolio or your loan portfolio, when rates go up, the present value of that portfolio is going to go down, and that's a bad thing. Now, liabilities, you know, you may see them as though they seem backwards. When rates go up for your liabilities, your present value is lower, which is a good thing. All right? So what we're going to do then is we're going to gloss over some of the details, but we want to make sure that we look at the main variables. The main variables we're interested in here are the duration or average life of your assets and liabilities, your cash flow, which is typically the coupon rate involved or the book yield, depending on how far or close to book your assets and liabilities are, and then the discount factor. A couple of rules of thumb: the longer the average life, the more present value or EVE volatility that's going to exist. The higher the cash flow, the less present value volatility or less EVE volatility. So a zero coupon cash flow is going to be your most volatile, and a premium is going to be less volatile. Now, a lower discount rate is synonymous with less present value volatility. Okay, so with those basics covered, let's talk a few things specifically about EVE. Number one, if you have a lower starting equity position, you know, sometimes we run into this. We'll find a financial institution that's you know, in a bit of a difficult situation. You know, maybe they've had credit issues that have turned into a capital issue, your EVE results can vary wildly. Second specific thing is, if you've got a really good match between your asset and liability durations, typically EVE is going to be a little smoother concept. Here's the kicker: non-maturity deposit accounts. If you have non-maturity deposit accounts, the one thing we know about them by definition is they don't have a stated maturity, right? They have uncertain cash flows, and that leads us really into the specific issue we're talking about today, and that is how to model your non-maturity deposit accounts. There are really 4 ways to approach this. Here they are. Number 1, you can take the approach that says, because from a legal or contractual point of view, your depositor can come into the bank tomorrow and withdraw them, you can put them in the overnight bucket. A lot of smaller community banks used to do this. I saw it a lot going into 07, 08, and what banks found out is that this masked the degree of asset sensitivity that they had. It's not realistic. It may be contractually or legalistically correct. It's not correct for modeling. Number 2, you can use your management judgment. You can convene a group of your top management team. You can talk about the experiences you've had at the bank in past rate cycles. You can use that judgment and that experience to come up with a good qualitative based estimate of how you think your non-maturity deposits are likely to perform. Now, the problem with this is, even though it's likely to be highly accurate, you don't have any backup. So when your regulator comes into the bank and they ask about your non-maturity deposit assumptions, and you provide them to them, and they shake their head and say, yes, this looks very nice. But then they ask that question, where's your backup? Well, you've got a problem. So then the third way is you can perform a deposit study. You can either do this in-house, or you can commission one. And this is a statistical study that, based upon the actual performance of your non-maturity deposit accounts, both in terms of average life and rate, you can model certain relationships. And it's an accurate thing to do from a statistical point of view. It also provides a significant amount of backup that your regulator is going to like to see. The problem is, none of us have extra money just kind of sitting around the bank. So, if we don't have to endure this sort of expense, we probably are going to resist that, or maybe try it in-house. The fourth way is the joint regulatory safe harbor, and this came out of Fiducia 305, which in and of itself was an outgrowth of the thrift crisis. What happened here was the regulators decided that one of the things they were going to do, they were going to propose that all insured financial institutions be subject to the same industry-wide interest rate risk model, and that this was going to let them compare apples and apples and rank order banks according to interest rate risk. And so there were lots of proposals and regulations, proposed regulations, and comments back and forth over a multi-year period. And ultimately, the point of view prevailed that said that banks were individually unique and distinct, and the regulators backed the whole proposal. But what we have here is we have a copy out of the Federal Register of what the regulators had published as the maximum allowable maturity distribution limits for non-maturity deposits without some form of documentation otherwise. So as you can see, you can lay out your average lives like this. Now again, if you know at your bank there are reasons why these sorts of maturity distributions overstate the likely maturity or average life of your deposits, it's incumbent on you as managers to go ahead and shorten up from this. But this is actually, it's my typical starting place with most community banks when they're looking to see how to model their non-maturity deposits. It's a good starting spot. But when you move beyond this and you want to look at how you actually model non-maturity deposits, there are two things you're going to do. You're going to look at decay rate. And decay rate is really another way of saying how do you estimate average life. All right? So decay rate lets you ask these kind of questions. How much does your non-maturity deposit account portfolio, how much does this reduce over time? Now, a high decay rate is associated with a short average life. A low decay rate is associated with a longer average life. And so if you don't take anything away from this in terms of the discussion other than this, just keep in mind that anytime you hear decay rate, think average life. It's just another way to get to average life. When people talk about decay rates, what they really care about is the average life of your non-maturity deposits. High decay, short average life; low decay, long average life. Now let's look at how these sorts of decay rate profiles compare. Here's 0.5% monthly. This is a 5.8 annual percentage, nice gradual decline. It's almost linear. 1% monthly, it's 11.4% annually. Definitely begins to get a little convexity to it. 2% much more so. And then 3% is really quite bowed. It's a steep drop-off to begin with. Now, again, other than being able to look at these pictures, these graphs, and observe that, say, for example, the 3% drops quickly, what we really want to know is average life. So here's how we would equate one to the other. The 0.5% monthly, it's somewhere just a little over 10 years average life. 1% is about 5.5. 2% is about 2.8. And the 3% is a little less than 2 years. Right? So what does this tell us? Well, it really tells us that seemingly small differences in your quoted monthly decay rate can make a huge difference in the average life of your non-maturity deposit account profile. All right? Remember when we looked at these maturity distributions for non-maturity deposits, the regulatory safe harbors? Well, let's look at what average lives these imply. Transaction accounts, that's about 2.5 years. Money markets, less than 1.5 years. And savings, that's the longest one of the bunch. It's about a 3.5-year average life. So these are not, by any stretch, these would not be considered very aggressive assumptions. These are, in fact, relatively conservative assumptions. So now that you have some idea of the rough ballpark for average lives and by definition decay rates, let's turn to look at the other side of the coin, and that's beta factors. Now beta factors, when you get right down to it, talk about how do we estimate the actual cash flows that are associated with these non-maturity deposits. Because remember what we talked about at the very beginning when we looked at the question of EVE, or economic value of equity, our long-term measure of interest rate risk. We wanted to do two things. We wanted to reprice fully the assets and liabilities, and we wanted to discount the cash flows back to the present. So we need both pieces of this. We need the decay rates to give us average life and the beta factors to give us cash flows. So let's talk about some basic beta concepts. Beta, when you hear beta, think about the rate sensitivity of your non-maturity deposit accounts. Here's the way to think of it. For every 100 basis points rate, I say rate hike, it's only because we can only about go up from here, how much will you raise your deposit rates? If your beta is 1, you're going to go up the whole 100 basis points. If your beta is 0, you're not going to change your rates at all. So your beta is going to fall between 0 and 1. Commonly, what we see for some of our less sensitive accounts, maybe your non-interest-bearing checking or your savings accounts, you're going to see betas in the range of 10, 15, 25%. It's going to vary significantly bank to bank depending on how it works. Money markets, you might see 50% beta or 75%. You can see as high as 85 or 90. Again, it's very bank specific. So here's the question really. How do you determine the different betas for your different types of products? And once you do that, and you do it through regression analysis primarily, a statistical analysis that allows you not only to calculate what the beta is, but to calculate a statistically significant measure that gives you a lot of cover, a lot of backup when your regulator asks about it. The second thing you need to think about are rates up versus rate down. Banks typically cut their non-maturity deposit rates much more aggressively when rates are on their way down than they raise them on the way up. So again, you're typically going to have a different set of betas for rates up and rates down environment. And of course, this will be important for your interest rate risk modeling. Again, I recommend that you have very, relatively speaking, very high rates on the rate down scenarios, much less so on the rates up scenarios. I just worked with a bank recently on calculating their betas, and what we found was that their betas were really high. In fact, their betas were significantly higher on their money markets and some of their other products. It's likely to change when we look at a rates up environment. So it's a moving target. Go ahead, run your numbers, and then be prepared to run them again. You're going to have to update this study on a regular basis. Now, if we take decay rate and beta, because we've walked through both of them now at some point, what we really are interested are in a few of the practical modeling relationships that they're going to tune you in for, right? So, because so many of you were interested in what can you do to improve your reported EVE results, I just thought it'd be a good idea to just go over some of the basics here on how changes in decay rates and betas are going to, generally speaking, all things equal, how they're going to impact your EVE results. A smaller decay rate means a longer average life. And it's just like any other liability. If you have a liability that has a longer repricing period, that's going to be a good thing from an interest rate risk perspective. And that's definitely going to be true with respect to your non-maturity deposits. Now, smaller beta factors, a smaller sensitivity, a less sensitive rate relationship, again, in these rates up scenarios, it's going to give you better present value cash flows on these liabilities. And here's the way I like to look at it. A smaller beta widens the gap between what the bank earns and what the bank pays. It's a lot like your net interest margin, right? If you pay the exact amount in terms of a rates up movement, if you change your rates, you're going to have a constant and never increasing margin, and that's not good, particularly because we've had so much margin compression over the past few years. When rates move back up, a lower beta could well be your key to widening that interest margin and widening your spreads. So here are a few practical issues. Number one, the safe harbor average lives. Remember, we looked at those. They tend to be around 2 to 3 years, some a little shorter, some a little longer. The reality of it is, if we actually study your bank and we study the way your accounts roll off and your own actual decay rates in your bank, we're likely to find that your non-maturity deposit accounts have a longer average life than this. And so, the regulators have been beating the drum on non-maturity deposit rate assumptions lately. It's been a real popular topic, going back really both to OCC and FDIC having some recent releases on this, talking about the likely more sensitive and more volatile behavior of non-maturity deposits. They better be careful what they're asking for. They might get it, and what they might get is do your own deposit study, and instead of a 2 to 3 year average life, maybe you end up with a 4-year average life. Now, that doesn't sound like a lot, but I'm going to tell you it's going to make a huge difference, just another year or so on your average lives in your EVE modeling. Second point here is bank-specific data is best. We hear that on so many things in interest rate risk modeling. Bank-specific data is best. But how do you do it, right? It can be difficult if you don't have an established process. You're not quite sure what to collect, when to collect it, and really what to do with it. Then, once you do that, you've got to document your assumptions. Based upon what I've seen recently, there are two types of banks. One type of bank, your regulator has already asked you for this. They've asked you to do your own study, right? The second type of bank is your regulator is going to soon ask you to do your own study. So, this has been meant to give you a little bit of an intro to these concepts and give you some framework to think about how you're going to get busy collecting this data in your own bank. And at this point, that's the basic teaching I wanted to go over on these topics. And so what I'll do is I'll check the question box and see if we have any other questions that have been submitted. I'm not seeing any questions at this point. I'll give everybody a few minutes yet. I've got a couple other questions that came in via email that don't fit in this general bucket. I did have a question about from a member about booking more loans. I'm a big proponent, and I think you've probably heard this from me in the past. I'm a big proponent of not modeling or not managing your bank based on EVE. I'm much more inclined to suggest you manage your bank based on earnings at risk. Number one, earnings at risk is a more reasonable concept. It's a more sophisticated concept, really, because we started with simple maturity gap, we went to dynamic gap, we went to earnings at risk. Now we have multi-period earnings at risk. It's a concept measuring short-term risk that A, has improved over time, B, has gotten more sophisticated, and C, just by virtue of the fact that it is a closer term, it's going to be more accurate. So what I would suggest is not getting too worked up about your EVE, instead focusing on your earnings at risk. When you look at booking additional loans, most banks, now when I say most banks, obviously this doesn't cover all situations, but most banks can stand to add additional 5 to 7 year fixed rate loans. If for no other reason, then there is 200 basis points plus of protection built into the curve. If you look at your 5 to 7 year sector, in swaps, because let's just say your alternative is to hedge things, and then you look at that compared with your LIBOR rate you'd receive, there's over 200 basis points of curve steepness already built in. So that means rates would have to increase over 200 basis points for you to be better off by hedging, okay? Now, I get it if your risk profile is such that you just can't take any more long-term risk. And in fact, I'd call this more intermediate-term risk, 5 to 7 year. But for most banks, you're much better off not giving up those couple hundred basis points of yield and net interest margin for a very skeptical reduction in what I think is a questionable EVE calculation. The thing about EVE is this. It's a static measurement. Now, static measurements are great. Static measurements on short-term risk make sense because what they do is they assume that your balance sheet mix doesn't change, your pricing relationships don't change, You don't do a different strategy. You don't add new assets at the current rate. So it lets you focus on interest rate risk purely. And that's very good and it's very appropriate for short-term risk, earnings at risk. But it's a bad answer for EVE because EVE, due to the long-term leverage nature of this calculation, it's like a compounding, right? So you take this whole run your bank on autopilot and you lever it out 30, 40, 50 years and you do present values based upon that. And what it does is it just accentuates minor volatility. So unlike short-term risk, which has improved in its sophistication and has become more accurate over time, EVE showed up after the thrift crisis and hasn't really changed. So I would say go ahead, book additional loans, and if you have questions about specific IRR issues, let's talk. All right. Let me just see if we have any more questions here. At this point, I don't see any questions. I'm going to keep the question box open for just a few more moments, but folks, if we don't get any additional questions at this point, I'll be bringing it to a close here in the near future. I did have another question about deposit studies that came in. The idea here is that rates have been on a downhill swing, really, almost relentlessly for about 7 years now. You can get some very very unusual results on your deposit studies if you're not careful. The number one thing I would say is make sure that you associate these recent few years with your rates down. Now, if you're just starting to do a deposit study, I get it. It's all you have are rates down observations. That's why you have to keep updating your study every year. All right. One final look at the question box. I'm not seeing anything. All right. I'm going to assume then that nobody else has any other questions. And what I'll do is I will start to bring things to a close here. This has been our teaching and Q&A time concerning EVE, non-maturity deposit, decay rate, and beta. This is Howard Lothrop. I want to thank you again for spending this short teaching time with me. Have a great weekend, and goodbye.